There's no turning back now. Wage-based inflation has hit us hard. We're going to take a look at that in just a moment. Welcome to the Brent Bruce Daily. Today is August the 31st. It is 10:42 a.m. Central Time, a little bit earlier today. Make sure that you like, subscribe, and share on the YouTube page. And if you are a real estate agent, make sure that you understand that people still think that the Federal Reserve is in charge of and has direct control over home loan interest rates. I think two people yesterday said, hey, how do I prepare for home loan interest rates going up? Because I read that the Federal Reserve is going to increase interest rates. That is not the case. This is an opportunity for you. Let me know. We can do a quick Zoom interview, record the video, and talk about, between you and I, we can talk about the fact that the Federal Reserve does not control home loan interest rates, and I can show the charts or whatever you want to do so that you can put that out on your social media and you can be the professional and you can educate your friends, clients, and anyone else who might be interested in that type of information. Why is it that there's no turning back now? Wage-based inflation. If you haven't watched my video on inflation spiral on my YouTube page, you need to watch that video because it is happening right now. This report came out today from ADP that shows private payrolls, and it was the smallest since 2021. Payroll numbers were terrible. Only 132,000 jobs created this month. This report was a survey of 25 million people. Why would only 132,000 jobs be created? Two reasons that I can think of. One is that if in general people are talking about the economy going either into a recession or the Federal Reserve choking out the economy in order to bring inflation under control, that doesn't sound like I want to go hire a bunch of employees. Doesn't sound like a booming time in the overall economy in the business world. So people will hold back and wait to see how those numbers turn out. Second of all, and probably more important, is that younger people today basically have conveyed the fact that they don't want to play that game. They don't want to go be employed. They don't necessarily want to go get the everyday job, put on their suit or put on their boots and go to work and get a W-2. I mean, most of them are going to. Most people are going to have to do that. But there are millions of younger people that are making their money other ways. They're outside of traditional employment. They wake up in the morning and they don't say, hey, I need to go to work. They wake up in the morning and say, hey, I need to go make some money. And those are two different things to them, especially the younger generation. So they are making money investing in crypto, investing in stocks, doing social media, gaming. There's all kinds of different ways, freelance marketing, photography, and some just say, I don't really want to go to work, so I'm going to go back to school and go back into the school world, live on either staying at home or school loans. There's all kinds of ways that people are getting by without necessarily going and getting a job through ADP, through the everyday employer. Okay. But here's the thing about inflation growth. Wage-based inflation. So if we look a little bit further, this is a great article, but look right here. The report also includes fresh insights into wage growth. Those who changed jobs, so went from one employer to the other, experienced a 16.1% pay increase from August of 2021 to August of 2022. That was twice the amount of those that stayed with their existing employers. Well, there's two things that jumps out at me in this paragraph. Number one is people that are working for a company that they like. They love their job. They work for, they've been there for 10 years, but they're having a hard time getting by because of inflation. And now their competitor down the street says, look, I'll give you a 16% increase if you do your same job, but you do it for me. They may love their employer, but if they're having a hard time paying their bills, they may feel like they have to make that change. So it's not because they were unhappy where they were, it's that they were unhappy with their pay and they felt like they needed to make that change. So all of a sudden, he who pays the most gets the employee because inflation is such a real problem. The other thing, though, is 7.6% gains for those who stayed at their job. That is tremendous. That is huge increases to payroll. Combined, the average, I think, ended up being 10%. 10% increase in general of employees in payroll in 1 year. Usually we're talking about what, 2%, 2.5%, 10%. And here's the problem: wage-based inflation. So inflation caused employers to have to pay their employees more. Who do you think is going to pay for that? People who run companies don't want to make less money. So when they have to increase the payroll of their employees, they raise the cost of their products and services, which creates inflation. That's inflation spiral. Make sure you watch the video. So if I have to pay more for my employees, I raise the cost of my products and services because business owners don't want to make less money. They are not just going to take the hit. Okay, so the thought that you're going to force business owners to make less money and share the wealth isn't going to happen. They're going to raise the cost of their products as much as possible in order to still be competitive. That increases the cost of products, so they got to increase wages and then products and wages. Now, traditional inflation can go up and down. Traditional inflation can go up and down. Inflation up, gas prices down, gas prices up. The cost of, I always use a Snickers bar, goes up, Snickers bar goes down. Snickers bar goes up, Snickers bar goes down because of the cost of peanuts or cocoa or who knows what, right? But once you raise the payroll of that company, Hershey's or whoever makes Snickers bars, they can never bring their prices back down as low as they were because the cost of business just went up permanently, right? When inflation subsides, do you think that these employers are going to be able to go back to their employees and say, hey, inflation's down now, I'm going to need to pay you a little bit less? No, they're not, because people aren't going to accept that. So the fact that payrolls go up is like a stop in the ups and downs of inflation. So now, again, it's a stair step. Inflation was here, payrolls went up, inflation can only go down here. And then it goes back and forth, and then eventually it goes up, and now if payrolls go up, now inflation can't go back down as much because the cost of doing business just went up. I hope that makes sense. Make sure that you watch my video on inflation spiral. So where are home loan interest rates today because of this? Overall, flat. Okay, we're down 3. The 10-year is basically flat. Everyone is just waiting to get the reports that come later on Friday, which are some additional employment numbers. And I think those are going to be the ones that dictate what's going on, unless more information comes out from the Federal Reserve or someone else that really makes a big change. Look at the Dow is only down 20. I mean, super flat all across the board. Home loan interest rates in general. Let's look at the Brent Bruce Daily. I know we're going long here, but you understand that this is some really important information I want to make sure that you know about. We were at 5.625% yesterday with a little bit of a credit, but it is also a very small cost. I think it was $209 or something like that to get a 5.5. Well, today we're at 5.5 with a very small credit. So, I mean, the movement in the market is negligent. There's negligible. There's not much movement there. To get to that 4.99 is 1.497 now. Yesterday we were at 1.6. So yes, a little bit of a movement there, but just not a lot going on. In general, 5.5% is our 30-year fixed mortgage with no points. I would probably be talking about a 5.375 with only 0.3 points with my customers, but that is where we are right now. Make sure that you reach out to me if you would like to have a discussion with me about the fact that the Federal Reserve does not have control over home loan interest rates. The federal funds rate is not home loan interest rates. I could talk all day about how they can manipulate the mortgage market, and we probably should talk about that. So give me a call. I'd love to be a resource for you and help you create content for you to put out to your customers and to your potential clients. Give me a call. Talk to you again soon. Have a great day. Bye.